Good afternoon. Hey, everybody, this is Craig Modelmog from Cornerstone Wealth Management with this week's episode of Wall Street X's and O's. Today is Friday, January 22nd. Hard to believe the first month of the year is about in the books. It's crazy. Time flies whether you're having fun or not, so I opt for fun. But anyway, to kick things off here, the information on this show, this is my standard disclosure, is for informational purposes only. This is not an offer or a solicitation to buy or sell anything. Investments can and will lose money, and they are not FDIC insured. So without further ado, we're going to kick this off today. We got a good show. I got some interesting stuff here today. We're going to talk about the Fed and their position on that there is no inflation currently. We're going to talk about voter turnout during the most recent presidential election, kind of some interesting facts and figures. We're going to talk about Wall Street's consensus positioning, meaning how is Wall Street and a lot of your big hedge funds and institutions currently positioned, which is pretty interesting here, excuse me. And then we're also going to talk about the Federal Reserve Bank of San Francisco printed like a working paper or a white paper here about the economic impacts of a pandemic. And they go back about 650 years. So got some good stuff today. So we're going to kick it off here. First things first, the Fed states and Fed Chairman Powell came out here and says that they really don't see any signs of inflation. I find that interesting because if you look at the commodities CRB index, and for those of you who are clients of mine, our commodities broad index that we own, if you look at just the CRB index for the last week and then 3 months, or actually the 3 months here last week, see, I'm trying to read and talk at the same time, and that's like walking and chewing gum. For me, that can be bad. For those of you that are joining me here for the first time, this is uncut and unedited. We grip it and rip it, kind of like John Daly hit the golf ball. Sometimes it looks like the best shot, and you really know what you're doing. Other times you're like going, dang, that dude really shouldn't play golf. So anyway, back to what I was saying, the commodities index has a 3-month increase in inflation, and this is broad commodities, that is, of 15.5%. Remember, Fed Chairman Powell, there is no signs of inflation. Oil, the 1 and 3 month inflation numbers, 1 month up 9.6%, 3 months up 25.1. What is that going to transpire into or transition into? Gas pump prices, most likely. If you look at corn, if you are a cornflake lover, if you like corn in general, if you like corn tortillas, guess what? The 1 and 3 month numbers for corn, 25.1% for the month. That is corn. Okay, and 3 months is up 30.1%. So when you hear the Fed or anybody in the government or on Wall Street saying there's really no signs of inflation, you can say you're wrong. And you know what? Craig told me that. So anyway, moving on. Presidential voter turnout. This is cool. I just love numbers. You all know I'm a stats guy. I'm big on statistics. I'm on math because the numbers don't lie. If you look at this year's election of eligible Americans who could vote, 66.7% voted, which was the highest number we have seen since 1900. Okay, and in that election, it was a see, I told you it's rough. I need a drink of water after that one. I can't even remember the name of the president back then, but he was going against a dude he had beaten 4 years before, and it was a big turnout, and almost 75% of the vote turned out in 1900. So, you know what? I am very glad everybody showed up, okay? Voter fraud, non-voter fraud, I'm not playing that game. I'm just not. We have a right in this country to vote, and every vote does count. Some votes, some would question count twice. Others, it doesn't matter. And I'm not making any reference towards that. So please don't misconstrue what I'm saying. I'm just glad people showed up because you know what? We should. It's a right. There are lots of countries around the world where they don't have a right to vote. So I'm glad people showed up regardless of the outcome. You know what? I'm proud of the Americans for showing up and taking an interest in the election. If there's one positive, which I think there are several, but if I look at a major positive of Trump, and I know for you Democrats, you're probably cringing now and going, oh, geez, what's Craig going to say? I think what President Trump did was he incited enough people's interest in politics and made people start paying attention. I think that's very good. So anyway, moving on. Wall Street consensus positioning. This is interesting. I get a CFTC. It's a CFTC non-commercial net long short position, which comes out weekly. What this does, it allows the Federal Reserve an idea to kind of see, it's like opening up the hood of the car on how are the big institutions, money managers, hedge funds positioned. Right now, they are net short, meaning they have insurance on their equity holdings as a whole, and that goes for the S&P and the Dow Jones. So I find that interesting, how people are kind of going, oh, I'm kind of nervous about where things are at. Here's what the data says, and you know I always talk to the data. Right now we are continuing to see the data report numbers that are strengthening from an economic standpoint and numbers that are strengthening from an inflationary standpoint. Historically, during times when you have growth accelerating and inflation accelerating, I'm trying to get my hands so they look right in this picture. See, I'm kind of a stickler for, that's not totally straight because my hands are broken, but anyway, in historical economic times when we've had growth accelerating along with inflation, that's posed a very good environment for stocks. So as you know, many of you who are my clients, we know that right now we're overweight equities and we also have really strong commodity exposure. On the bond side, we don't own any U.S. government treasuries. We are straight corporate, high yield, international, particularly on the emerging market side. So we are really prepared for this type of environment. What do I anticipate? I think there's an opportunity for Q1's GDP number to be a number unlike we have seen in 80 to 90 years. It could be double digits. I know that might be a stretch. And again, that's just kind of what the projections are showing now. And obviously we will see, but Q1 should be really good as the vaccine continues to roll out, as the economy continues to slowly reopen. I tell you, we should have a pretty good number. We don't have a very big number to beat, so remember that Q1 of last year was a disaster. Pandemic, shutdown, terrible. Okay, so this is where I really think, and you can see they're coming to look at my heating and air conditioning. I am sorry, I cannot answer this, Tanya. This is why I did not answer it. So anyway, it's all good. It is all good. See, I told you it's legit. It's uncut and unedited. So we're going to move on here. So anyway, again, Wall Street net short. Lots of protection, meaning they're buying protection, buying insurance on their portfolios. As the data continues to be reported, you're going to see this net short position, assuming the positivity continues to grow and build, you're going to see that shrink. And I think that is also going to lead to the markets being a really promising place to be. So I'm really excited. Okay. Moving on here, last point of the day. The Federal Reserve Bank of San Francisco came out here in June and they wrote a real interesting piece. You can go pull it up. It's called Longer Run Economic Consequences of Pandemics. I'm going to paraphrase. Basically, they went and they looked at a time series, and they went back 650 years, and they looked at all the different pandemics since the year 1350, which was the Black Plague. Okay, the criteria for a pandemic, there had to be at least 100,000 deaths. That was the baseline. Okay, of which there were many. All right, right now, COVID-19 is tipping the scales at number 3. All right. The Black Death and the Spanish flu. Spanish flu was early 1900s. Black Death, that's the one that goes back during the Dark Ages as well. A little history lesson here. What is interesting is it wasn't like things get back to normal quickly. And this is something where I'm not trying to rain on the parade. I'm not trying to enhance or incite concern or negativity, because I'm actually fairly positive about the economy. And as you guys know, I really invest for what I call a full macroeconomic cycle, meaning there are always places to make money. So I honestly don't care what the markets do. I know we're going to be able to go find places to make money. So I'm really not concerned. I'm actually excited to see what happens. But historically, they talk, when you go through a pandemic like this, it takes 30 to 40 years for an economy to get back to normal. That's a long time, okay? 30 to 40 years, all right? What we have to remember is this: this virus is not Democrat or Republican. All it wants to do is infect us. We're seeing now that there are mutations happening. I was on a call earlier in the week and they said that right now they have traced and tracked more than 13,000 mutations. That's a big number, 13,000. You don't hear that very often. And again, I think they try to manage a lot of the data because they don't want people to freak out. I understand that, but again, I'm all about transparency and let's really focus on the facts here. So, but also when I think about compare and contrast now versus the early 1900s, which was Spanish flu, versus the Black Plague, here's the difference. We've got a health system now, global, but let's focus here on the United States, that really saved and protected a lot of people. So I don't think you can compare and contrast that. We've saved and protected thousands of people, even though our fatalities are high. And it's a terrible, terrible thing. There still have been a lot of positives, okay? So that's where I think, that 30 to 40 year time from getting back to normal may be a stretch. They also didn't have the benefits of government stimulus, government support like we do today. You go back to the crash of 29. People always talk about that. Are we going to have another crash? I would say to that degree, it's unlikely. Is it possible? Anything is possible. But it's unlikely in that because back then, that's what a crash looks like when the federal government doesn't step in and backstop everything. Big difference. And you have to keep that in mind, okay? So again, we need to get the politics out of this. We also need to know that lockdowns, sadly, the data hasn't supported that lockdowns work. What lockdowns do is they destroy economies, okay? That's the thing that I'm most focused on. And most concerned about, because you're seeing how the talk is, wow, it's shut down. Oh, we do. The problem is the data doesn't support that. So as we move forwards, okay, I'm anxious now that we have more and more data coming out. We're going to have a better idea of what it looks like. And did this work? Did this not work? Honestly, I think we're going to look back and the shutdown that happened into February, March, or actually March, April, we're going to see is probably one of the biggest mistakes that has ever been made. That may be right. It may be not right, but I'm not sure that is the answer. It's more people individually taking ownership for their conduct and how they carry themselves, knowing if they are high risk, they need to take certain steps to protect themselves. If they are not, etc. But then for the people that are not high risk, it's respecting those that are. Anyway, I'm not going to delve down that because, that's kind of a runaway train. But when you look at shutdowns here, and here's my point from an economic, and I want the focus to be on the economic impacts, not the political standpoint or anything from a belief or any of that. Let's just look at the economic impacts. When you look at the United States specifically, small and mid-sized businesses make up 50% of all the jobs in this nation, of which that transitions to 45% of our GDP, gross domestic productivity, comes from small and mid-sized businesses. So when you do these lockdowns, how can you not have an economy that's not been fractured? That's my question. We saw the government come to the rescue, and we saw them spend more money than they've ever spent in history. Our debt as a country is like over $8 trillion now, which is just incredible. We're seeing a labor participation right now back to the same levels as we saw in the 70s. That's because we have lots of people that are out of work and underemployed, unemployed, underemployed. Okay. This concerns me because you can't have an economy survive this for any lengthy period of time. So when you look at what's happened, and we're seeing now I had a friend who has very close ties to the UK. They're on lockdown again, and they're saying, hey, you can't go out of your house but like once a day for a certain period of time. You can't go more than a mile or two from your home. I mean, these are serious lockdowns going on in Europe. I think Europe, by the way, double dip recession. Okay, side note there. I think when you look at that and how do you combat that? Well, our government has taken a stance of stimulus. Now we have Biden and his administration firmly getting entrenched here. Okay, you basically have, I'm going to call it Obama 2.0, and I say that respectfully. President Biden was President Obama's vice president, as we all know. Many of the appointees by President Biden were on Obama's JV. Again, I say that respectfully because, again, you don't come into high school and start varsity. Not very often. Okay, this is how the political process works. You come in on the JV, you're on the sophomore team, you're on the JV team, and then as the next group comes into play, then you're moving up the ranks. That's just natural. So we kind of know what to expect. We know a couple things. We know this pandemic is not going away. It is not going to go away. Okay, this vaccine protects us for a period of time, just like the flu vaccine, just like the common cold. It comes, it metamorphoses, it mutates every year. This is here to stay. Taxes most likely are going to go up eventually. The economic struggles are possible. I would say probable. Okay. The Democrats right now are really focusing, I believe, and when you go back and compare and contrast when Obama first got in, and I think what I'm seeing and hearing is Democrats look back, and you live and learn, right? They're looking at when Obama got in, and he didn't get as much accomplished in his first 2 years as he could have, and then everything switched, and then all of a sudden he's fighting uphill because he lost control of the House and the Senate. So I think you're going to see the Democrats be very aggressive here because they not only have the presidency, they have a slight majority in both the Senate and the House. So I think you're going to see them front end load a lot of things over the next 2 years here, which again are going to be very supportive of the economy, very supportive on trying to level the playing field. And I think a tax raise is part of that. I think you're going to see infrastructure. That's going to be part of that. A lot of this is I know we're going to be spending money because that's kind of the new thing. It's MMT. I've talked about that. Modern monetary theory. That's the new theme of the day. The kicker is in how do you pay for that? Do you legalize marijuana at the federal standpoint and tax the tar out of it? Do you increase taxes for the wealthy, for the affluent? They're going to have to come up with some type of strategy to pay for these things, and most likely they will. Okay. The concern I have is if we continue on our current path, our debt to GDP is going to be in excess of 130, 135%, which puts us in the same category as Italy and Lebanon and Greece. Those aren't good people you want to hang with. Okay. Now, we're different than those places. We are. But at the end of the day, you know what does that do to our global stance as a country from a stability? I don't know. There's lots of question marks out there, and I'm actually very excited to check it out and watch. It's history in the making, as it always is, and I'm excited. I'm also very opportunistic. Again, I really focus from a methodology standpoint on you either have a belief system or you have a risk management system. I've opted for a risk management system, as most of you know that know me, where I really dial into the data and the math of what's happening, and that drives our processes, and that is what is going to continue to drive our processes. So in closing here, lots of exciting stuff going on, okay? I'm very opportunistic. I think we've got a quarter or two of positive markets. Obviously, time will tell. Right now, that's what the data supports. As the data changes, we will adjust and make changes accordingly. And that is something you can count on. So, in closing here, it's great to see you guys. For Friday, January 22nd, this is Craig Modelmog with this week's episode of Wall Street X's and O's. Everyone enjoy your Friday. Have a fabulous weekend. And until next week, I am